Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. And as Mr. Valuation, I'm constantly looking for good value that I can invest in. But there are other attributes that I admire as well. I like companies when I can find them that produce consistent operating growth. In other words, companies that consistently grow year after year after year. I want to see that growth in earnings. I want to see that growth in cash flows. I want to see that growth in dividends, et cetera, because, there's an old saying that says success leaves clues. Now, there's also a saying that says, the past is not necessarily an indication of the future. And that is true, which requires always doing your homework and your due diligence. But on the other hand, a company with a great track record, there's also real value in track records, and companies with great track records tend to continue to produce similar track records going forward. So that's one reason why I like that kind of consistency. But let's go ahead and take a look at the overall market here first by moving into FastGraphs. And let's look at the S&P 500. This is our, classic S&P 500 graph. And for those of you who aren't familiar with the tool, the orange line represents intrinsic value. In the case of the S&P, that's a PE of 15 times earnings. The blue line simply calculates how the market has valued the stock over this time frame. In other words, it's kind of the market value line, and the orange line is the intrinsic value line. And what you see here is some very interesting, what I'll call examples or lessons about valuation. You can see that the price kind of tracked, coming out of the recession of 2001. The S&P traded within this 15 to 17 times earnings kind of range, if you will. And then we hit the Great Recession and earnings fell. And the S&P was trading at the high PE. And then, of course, it got undervalued. It actually traded below the intrinsic value PE. And, in contrast to the high market value PE. And then pessimism, tends to hold. Emotions that people have do tend to hold for periods of time. I think that's something that people often neglect. When you get euphoria, it tends to last for a while when people are overly optimistic. And then when people are overly pessimistic, that tends to last for a while as well. And, the reality of investing is that the two dominant emotions are fear and greed. Now, fear to me is always the most dangerous, but greed can be just as, we'll call it, irrational and as dangerous to investors. In fact, in the long run, it can be more dangerous if it gets really out of hand, like I believe it is today. So once we hit kind of 2014 and the market looked like it was going to be performing well for, 4 or 5 years in a row, people got more and more optimistic. And you can see that by the valuation of the S&P getting higher and higher and higher. And now we've almost hit this crescendo where we have a separation even from these normal intrinsic value lines. And that's despite the fact that we ran into COVID, in 2019, which created this flash crash here that we're all familiar with by now. And now we've had this remarkable recovery. And it's like, euphoric optimism is reigning even higher than it is today. Now, back during that time, I do want you to notice I put a red dot on the graph here. This was April of 2019. Okay, and this is a time where the market actually did kind of sag a little bit during that period of time, obviously. And we had, as I mentioned, we had the flash crash, we had the COVID happening in 2019, actually in 2020, but both. But the reality of it is that the market got almost reasonably priced during that period of time. It was a good buying opportunity. But during that time, I also produced a video and I covered 5 companies. And I'm going to go to that video right now. That video was produced in April of 2019. And this is what Fortune brands look like. Now, I put a link in this video to that. You'll be able to go to it at around the 8-minute mark. As you can see here, I covered Fortune brands. And at that time, Fortune brands had become very, very inexpensive. All right, so the stock was trading as of April 11th, 2019, it was trading at $49.11, and it offered a dividend yield of 1.8% and a PE of 14.3. This was an extremely attractive time to be investing in Fortune brands. So let's go ahead and update you here, and let's look at what Fortune brands looks like today. And here's that red dot. That's that April of 2019 where I basically produced the video that, you can go ahead and go back and revisit, because there's several other good candidates that I covered in there. And you see some very interesting things. You see how inexpensive Fortune Brands was at that time. Again, there's that 14-ish PE. The current blended PE is about 17.5 right now, so it's got a higher valuation than it did back here, but relative to its earnings growth, which averaged over 23%, here I'm using a PE ratio equal to the company's earnings growth of 23. And that was a good historical growth rate since they were spun off of the original Fortune Brands, actually in 2011. Okay, the company's now had 10 years of history, and I'll get into more of that here in a little bit. But now you can also see the COVID, crash that I talked about, the flash crash, where the stock became extremely inexpensive. So, a year later, it looked like a really bad idea. Now here we are a couple of years later, it looks like a really good idea, and it's still relatively attractive. Now, I do want to talk about growth a little bit, okay? And I'm going to go ahead and get rid of these dots on this graph here. And I want to take price off of the graph because I want you to see what I like about this stock. Okay, I like the fact that their earnings grew year after year after year. All right, earnings are not the only metric I look at. Now, I'm using operating earnings here. I can also use diluted earnings, which a lot of other sites have, and that's where you'll see different numbers and even different multiples. Diluted earnings have also been very good. And of course, diluted earnings include certain accounting conventions that you don't get with operating earnings, which leads me to operating cash flow, which is, to me, the ultimate is I like cash flow because, earnings are optional, as the old saying goes, but cash is king. And this company also has produced a very enviable record of operating cash flow growth at just under 17.6% per annum historically here. And again, note that they started paying a dividend, that's the white line, in 2013, and they've increased that dividend every single year since they've paid one. Again, these are the kind of attributes that I like. Now, free cash flow is also critically important because free cash flow has also grown at over 18% a year, and free cash flow is also, covering the dividend very strongly here. Now, I can also look at this. Now, by the way, I'm going to bring price back into the equation here so that you get to see, I don't use free cash flow as a valuation metric as much as I like to use things like EBITDA, which is more of an operating cash flow. It's earnings before interest, taxes, depreciation, and amortization. So it's earnings before the accounting convention gets involved, which is what really diluted earnings are. And you can see it's trading at its normal price to EBITDA has been about 12.9. That's the multiple of the orange line on EBITDA. It's currently trading at 10 times that and has an EBITDA yield of 9.5%. And just like I do in earnings, I like to see 6.5 or 7%. EBIT, or earnings before interest and taxes, the stock also looks cheap in terms of it's got very consistent growth of EBIT. And then finally, I want to take a look at it from a sales point of view. If there's one metric here that it's a little rich on, it would be price to sales. It's normally trades at around 1.67 times sales. It's currently at 1.84 times sales. So that would indicate that it's a little bit rich, regarding that. But earnings are the things that we hear about the most. Earnings are the thing that we see Wall Street talking about the most. And looking at it from an earnings per share point of view, the stock looks very undervalued. Now, I do want to give you a caveat. Earnings growth is dynamic. This is calculating earnings growth going back to the beginning of 2012. If I shorten that time frame a little bit, now earnings growth has fallen to 20.7. I'll shorten it a little more. Earnings growth during this period has been about 14.4%. I shorten it a little more and we're back up to 18%. So I do want to point out that earnings growth is somewhat, inconsistent, but yet consistent at the same time. Now, going into the forecasting calculators here of FastGraph, I have this handy little graphic here. This is using historical growth rate in lieu of analyst estimates. Okay, now the 5-year historical growth rate has been about 15.15%, which I have here. And again, if the stock were to trade at that 15 PE ratio, this would be a double-digit grower. The normal price earnings multiple, which I also have a handy little graph on here, has been on the low side 18 times earnings. The last 5 years, it's been 20 times earnings, but it's also traded as high as 22. Now, based on that basis, if it continues to command that, above average PE. Now we got a stock that's capable of generating 20% annualized rate of returns over the next couple of years. All right. Even if I use the lowest, the 3-year normal PE ratio, I still get over 15% annualized, rates of return with these normal multiples. Now, the actual consensus estimate for growth is for almost 38% this year. And that's obviously, as I'll show you here in a moment, related to housing and how strong housing currently is, followed by 9% next year, and then followed by 11.9% thereafter. All right, so we still have a 17% double-digit earnings growth rate, which is consistent with what we've seen historically here when I use, the max at the 23% growth, the 20% growth, or even the 14% growth. In other words, it's within those ranges, if you will. But I also want to point something else out very important that I really like about this. The stocks 6 months ago, the consensus of 17 analysts following the company expected just under $5, $4.99. Then 3 months ago, they raised that to $5.63. And then just recently, they've raised that to $5.78, which is that 38%. That's the current consensus. We see the same thing with 2022's numbers. They've gone from $5.50 to $6.17 to $6.30. And then going out to 2023, where we drop off to only 3 analysts, we still have this positive outlook on the stock. Now, looking at the analyst scorecard, if I look at the analyst scorecard over the 1 year forward, the analysts have got it right 80% of the time. We had 2 misses, one in 2014 and 15, and I'll speak to that more later. This is how accurate have the analysts been when they were making an estimate 1 year in advance, and we give them a 10% margin for error. When they were making 2-year forward estimates, analysts were right, or they were right 60% of the time, and the company actually exceeded their estimates 40% of the time. But they're on a streak of about 6 consecutive times where they've gotten very, very close, where the analysts have been very, very close with their estimates. So the analyst scorecard on Fortune Brands, looks very, very good. But again, the thing that I really like about this company is the consistency of its growth. Now, there are variations where you have periods of very high growth and then double-digit growth in between, then very high growth again. Then here's a couple single-digit years followed by high years. So I think you can, you might think about expecting that in the future because of the nature of the beast. So let's talk a little bit about what the company does. So what I've done is I'm going to go to the external links here and click on, I'm going to go into Fortune Brands website for you so you understand a little bit about the company. Now, this was spun off from the original Fortune Brands company. All right. And Fortune Brands was diversified. They had spirits, whiskey and stuff like that as others. This is what I'll call the construction side. So if you look at their 3 primary businesses that the company currently engages in, they have plumbing, and Moen is their lead plumbing brand. It's an extremely well-known brand, but you can see also some other, very notable brands in the plumbing, side of their business where they build all these different plumbing items and so on. Now go back into brands. I can go into outdoors and security. The company makes everything here from doors and, storm doors. They also make locking systems. They also make screen and porch windows, composite millwork, security devices for the home, fiberglass entry doors. But then they also are actually the leader. Their master brand cabinets is actually the leader, but they also have other cabinets. So obviously, this company is very, very tied into the construction industry, and housing, especially new construction, has still continued to be as strong. Now, we do have the fear of interest rates. That's something that I think you ought to be aware of and looking at. But the reality of it is this company is seeing real strong growth across its entire portfolio as a result of strong U.S. housing demand. And, Morningstar talked about that in the recent research report I read on it. Morningstar also gives them a narrow moat, but it does have a moat. And they do think that their moat is supported by the pricing power of its Moen and Master Lock brand names. Master Lock is another big brand name in the security side. So when you look at this company all in all and look at it from a standpoint of historical performance, and I want to go to the old version of Fast Graphs here to look at that for you, because the new version that I'm using to show you some of the nice new features we're having is not quite fully functioning yet. But I hope as you see as I go through this video even today that it's getting closer and closer. But you can see the company has strongly outperformed the S&P 500 since it's been a publicly traded company. It did it in both dividend income, and it's also done it in capital appreciation. And I think that's really important. But I think the key is that the stock is inexpensive enough now, based on its growth potential, that it's a very, very attractive opportunity for those of you who are looking for capital appreciation and dividend growth. Now, the yield is only 1.1% currently, and that's in line with what the average stock is producing right now if you went back to the S&P 500 graph. But its dividend growth has been far superior. And I want you to throw out, when a company starts paying a dividend, you'll often see the very next year they really increase their dividend a lot. The company kind of gets the feel for dividends. So if I shorten this time frame a little bit and take those two crazy numbers out, if you will. Whoops, I got to shorten it. I didn't shorten it enough. If I take those two crazy numbers out, then you'll see that the dividend growth rate has averaged double digit, about 11%. Last year, which was a tough year, was about 9.1%. And you can see it was 14, 12, 11, and 10. So the company has produced very strong dividend growth historically, over the time. Now, the market value of this stock relative to the S&P 500 has not performed as well as the S&P 500. I want to remind you how overvalued the S&P currently is relative to how undervalued Fortune Brands currently is, or a fairly valued Fortune Brands currently is. So anyway, this is a very high quality company. It's triple B plus, which is one grade below investment grade. Has a very strong balance sheet. There are other ways that we can look at this stock. We can go into the fund graphs here, which stands for financial underlying numbers. And I do want to look at things like their balance sheet. I do think the companies, if you look at their debt situation, they have 47% debt to capital. But if I look at it from a standpoint of long-term debt versus short-term debt, most of their debt currently is long-term debt. I think that's really important. If I evaluate it based on the cash flow, you can see that they do generate very strong cash flow growth, and their free cash flow growth is also very strong. And then if I look at that from a standpoint of looking at cash dividends, their free cash flow and operating cash flow is really covering the dividend, very well. So, when I look at dividend coverage and the ability for this company to continue growing their dividend, I feel that it's very well positioned to do that. I might also add, going back to this performance, that they're only paying out about 20 to 25% of their earnings are being paid out in dividends. So they have a very attractive dividend payout ratio. As the company grows, I wouldn't think it would be a stretch to believe that they would be able to increase their dividend if dividends became more important to the company. And what happens is if growth starts to become more difficult, companies will tend to focus more on their income. That would be a possibility here. Anyway, I like this company very, very much. I love its consistency. I love its quality. I like the fact that the company also has, good profitability ratios. If I look at things like return on invested capital, it's double-digit returns on invested capital, which I like. If I look at their gross margin is in the 30+% range, which I also like. Their net margin is about 7 to 10%, which I think is also, very acceptable for companies in this particular industry. So when you, weigh it all and look at it from all aspects, I really like Fortune Brands Home and Security here. I think the recent dip has given us an opportunity to acquire it. If you can get it cheaper, even better. But I think this is one that if you're looking for GARP, growth at a reasonable price, it's one that investors can look at with confidence. Anyway, this has been Chuck Carnevale saying, hope you liked my article here on Fortune Brands. I hope you go back and look at the video I did previously and look at how it's performed. You can see where fundamentals really dominate, and you can also see how short-term price action can be very irrational at times, but eventually stocks move back into alignment. If you like this video, give me a like, ring the bell, subscribe to the channel if you haven't already. We really appreciate all you and appreciate all the subscribers that we already have. And we look forward to producing more videos like this in the future. Thanks for watching.